The 48-hour rule in financial terms is a guideline or requirement that stipulates specific transactions or processes that must be completed within a window of 48 hours. This time frame is often implemented in various financial contexts such as banking, trading, or regulatory compliance. For instance, in banking, the 48-hour rule might govern the processing of deposits or withdrawals. When a customer initiates a deposit or withdrawal transaction, the bank typically has 48 hours to complete the transaction and reflect the changes accurately in the customer's account. This ensures timely access to funds and maintains the efficiency of banking operations. Now, similarly, in the trading and investment context, the 48-hour rule the 48 hour could pertain to the settlement of trades. After the execution of a trade, financial institutions usually have 48 hours to settle the transaction by transferring securities or funds between relevant parties. Adhering to this rule helps prevent delays and ensures smooth functioning of financial markets. Additionally, regulatory bodies may impose that the 48-hour rule as part of the compliance requirements. For example, certain reporting or disclosure obligations may necessitate financial institutions to provide relevant information within 48 hours of specified events or requests. This ensures transparency and accountability within the financial system. Overall, and in conclusion, this is just a simplified explanation. Overall, the 48-hour rule plays a crucial role in facilitating the efficient execution of financial transactions, maintaining market integrity, and upholding regulatory standards. Now, if you have any more questions about that, please let me know. And if you liked it, hit the like button if you want to. And if you need more information on this, let me know in the comments and I will tell you more in a separate video, of course. Take care. Thank you.